Welcome to Blue Nile Tutorials. The going concern review assesses if a company can continue operating for at least the next 12 months. Auditors rolly evaluate management's assessment. Review management's evaluation of the company's ability to continue as a going concern. Identify risks. Look for warning signs like losses, cash flow issues, or legal challenges. Review mitigation plans. Analyze management's plans, such as cost reductions or securing funding. Gather evidence. Validate assertions using forecasts, agreements, and other documentation. Audit impact if risks exist. Enhanced disclosures or a modified audit opinion may be needed. This review ensures financial statements reflect the company's stability. This video will cover the going concern review. This forms part of the completion and review stage of an external audit. The aim of the going concern review is to ensure the auditor has considered whether the client is likely to continue in the foreseeable future, and whether they had prepared their financial statements, including appropriate disclosures. The entity must decide when preparing their accounts whether they believe they will continue to trade in the foreseeable future, for example, within the next 1 to 2 years. Based on their decision, the format of the financial statements will change. If yes, then they will prepare their financial statements using the normal or going concern basis. This is how we see most financial statements being prepared. If they are not sure, maybe due to financial difficulties, then they should prepare on the going concern basis, but with additional disclosure. This disclosure should then explain the uncertainties to inform the users. If they believe they will no longer continue, for example, if they have decided to close the business, or it is impossible to continue trading, then the financial statements will be prepared using the breakup basis. It is the director's responsibility to assess their ability to continue when preparing the financial statements. They should therefore review this using the cash flow forecasts and budgets, considering finance needs and sources of finance, and their profitability. With the financial statements now prepared, demonstrating the client's perception of their business, it is the auditor's responsibility to review them and decide whether they agree with the basis. ACCA 570 states that the auditor must identify if the financial statements are being prepared using the appropriate basis. The only way they can do this is to perform specific audit procedures that will obtain evidence on the client's ability to continue. This is left to the end of the audit to ensure that events since the year-end can also be reviewed, as these may have an impact on their foreseeable future. The auditor should look for indicators of going concern problems. For example, indicators include imminent bank overdraft reviews by the bank, slow payments to suppliers, failure to pay staff, customers not paying or significantly slower to pay, defaults on loan payments, tax payments missed and fines, industry or competitor changes, loss of market share, net current liabilities, net cash outflow, and making losses. The auditor should perform audit procedures to obtain evidence that supports or questions the decision made by the directors on their going concern basis. The evidence that will typically be obtained will be correspondence from external sources, board minutes, post-year-end accounts, cash flow forecasts, loan agreements, written representations, and inquiry with management and company lawyers. Correspondence should be reviewed to identify any possible issues that have not been highlighted by management. Customer correspondence should be reviewed to identify problems with customer relationships, and if any big customers are no longer trading or no longer trading with the entity. Supplier correspondence should be reviewed to identify if suppliers are supplying on time with credit, or if there are any problems, for example, if the entity is not paying on time. Bank correspondence should be reviewed for evidence such as if a bank overdraft review is due, which could indicate cash flow problems if it is in use. And tax correspondence would be reviewed for evidence of non-payment, fines, and penalties. Board minutes would be inspected to identify discussions on any issues that could cause problems for the entity. Review of the board minutes before and after the year-end would be advisable. The auditor would inspect any post-year-end financial information such as management accounts or interim financial statements to identify if the performance of the entity is consistent with the current year being audited. It may highlight if revenue and profits have fallen or if there are large sales of assets just after the year-end. Any of these issues should be discussed with the client if detected. An analysis of cash flow forecasts the client has prepared would also help identify potential going concern issues. The auditor should assess how reasonable the assumptions are that have been used to prepare the forecast. Audit procedures such as agreeing the opening balance to the actual balance in the cash book, comparing income and expenditure from the budget to the movements in cash in the forecast, and post-year accounting information will all go some way in deciding how reliable the cash flow forecast is. Then, considering the level of cash planned for the business will also help decide whether the client is a going concern. Negative cash planned would be an indicator of going concern problems, where disclosure may be necessary in the financial statements. Inspecting loan agreements held by the client is important so the auditor can highlight if any loan covenants exist or if a loan repayment is due. If conditions are attached to loans, for example, the company must ensure debt is kept below a certain limit, the auditor must assess if these covenants are in breach. Inquiry with management to discuss their future plans or give explanations to anything found by the auditor will help them decide if going concern disclosure is required. Inquiry with the company lawyer will identify any existing litigation issues which could cause future problems for the entity. If a court case is looming, compensation payments may be possible, and an effect on their reputation may affect future revenue growth. Audit procedures such as these mentioned will assist the auditor in gathering evidence to decide whether they agree with the going concern basis used. If in agreement with the client and the entity is a going concern, there is no further work needed. If there are issues, or the auditor disagrees with the basis used in preparing the financial statements, then the auditor must discuss this with the client and advise what will happen next. Firstly, if the auditor believes the entity has a going concern problem and disclosure is necessary, as long as disclosure is adequate in the financial statements, then the auditor can issue an unmodified, unqualified opinion. However, the audit report should be modified with an emphasis of matter paragraph to highlight the uncertainty and make reference to the disclosure included in the financial statements. If disclosure is needed and the client refuses to include anything in the financial statements, the auditor should discuss the impact this will have on the audit and the audit report. From the auditor's perspective, if they believe disclosure is required, then without it, there is a material misstatement. The audit report would be modified with a qualified opinion. This is likely to be an adverse opinion and the basis of opinion paragraph explaining the uncertainty to the client's future. In this video, we have covered the aim of the going concern review, how going concern affects the financial statements and the director's responsibilities, the auditor's responsibility towards going concern disclosure, the typical indicators of going concern issues for the entity, the typical audit procedures carried out by the auditor to establish whether the client is a going concern, and finally, the conclusion of the auditor's work in this area and how it affects the audit report and opinion. I hope you found this video useful. Thank you for watching.